Earnings are out from Meta and Microsoft, with both of the major tech giants reporting solid numbers. Most importantly, Meta has committed more capex to building out AI infrastructure in a time where everybody was expecting things to actually slow down. And this is exactly what might continue to fuel the market rally and the reversal we've seen in the upward direction. NVIDIA is already up roughly 3.5% on this news after hours. So welcome back to the Trade Brigade Midweek Show, where we'll take a look through all of the data points and we'll build a logical trade plan. My name is Matt, and if you're new here, hit the thumbs up button and subscribe. For additional resources, check out the links listed down below in the description, and stay tuned until the end of today's show. I've got 3 additional trade ideas to share with you that you won't want to miss. With that said, let's jump right into the charts. So we'll kick things off tonight on the SPY monthly time frame chart now that the April bars have officially closed out. And would you just look at that thing, a huge monthly hammer candle. Most importantly, in terms of structure, we'll talk about location of that lower wick, but notice how we've closed inside of the previous month's range as well. That's definitely a bullish indication here on the higher time frames. But again, in terms of the location of that lower wick, it's picture perfect. It belongs in a textbook, and I think it supports more of the bull argument as well. Previous resistance is acting as newfound support. This is over the monthly 50 SMA, that's the blue moving average on your screen. And we tied in confluence with this support trendline from the sickness low to the 2022 drawdown low. It's picture perfect. Once again, put it in a textbook, and this supports the bullish thesis, simply noting that in a stronger bearish market where, oh my goodness, let's sell everything, nuanced technical levels like this are not going to hold as support. So the higher time frame, definitely more bullish than bearish on the monthly close of the April bar here, especially noting once again that we've closed inside of the previous month's range. As we drop this down through the time frames, let's take a look at the weekly bar. It's in development. Of course, it's not closed. It will close on Friday. But what I would point out is just the lack of early week rejection underneath the 550 level coming from this previous low. You can see as of Wednesday's close, we're certainly above the level, and there is a lower wick that suggests that price at one point, even during today's session, was underneath that previous level at 550. So much more of a bullish indication here as well. And in the after hours, with the positive news from Meta and Microsoft earnings, the market is trading higher at roughly 557.85 by 93. Let's just round off and call it 558. That's certainly a step in the upward direction, loosely kind of right where my cursor is being hovered. So towards the highs of this range, if not a slight gap up for tomorrow's session. Let's drop this down to a daily time frame chart and see what's going on from this perspective. And this is where we can get a little bit more nuanced. Let's start reading into the trend count here. Of course, on the daily time frame, the bullish base case has outlined that the capitulation low here is turning into a structural trend reversal with a set of equal lows happening here, and of course in the trend count, those are higher lows relative to the capitulation low. We've also made note, as of the Saturday update video this previous weekend, that we did see as of last Friday's close a move to take out the 90-day pause high, bringing in a nuanced higher high. So we know that the trend is technically up here on the daily time frame, and all of the price action that we've seen this week is really not in contrast to that. There's nothing here that's suggestive of a daily trend reversal. As a matter of fact, if we read into the idea that on Tuesday's session we actually produced a higher high in the trend count, today we know that we opened on a gap down. The GDP numbers were actually quite frightening, at least at first glance through the pre-market session. And in the early stages of today's intraday session, right, there was certainly a push to the downside here back into the tariff turmoil zone, which would have perhaps kept the weekly threat for that lower high alive. But look at where we've closed. So what I want to actually do here is just reinforce that the daily trend is certainly in the upward direction. There was no hourly trend reversal. This, if anything, is a soft higher low in the trend count. And even if we pull back, I would still maintain the optimistic stance that you could get a daily firm higher low if the hourly trend flips to down, as long as we're over this gap fill reversal level here at 530. The trend count would look such that we have lows, higher lows happening here, and you could make the argument that this would be the next higher low in the trend count. Now, that does come with some risks associated with that move. Of course, there is the threat that a lower high here would then start to suggest a look above and fail on the tariff turmoil zone, but we'll take that in stride when and if it develops. But once again, in the after hours, things are seemingly pretty rosy right now with the forecast for a potentially small gap up for tomorrow's open. Let's take a look at the hourly timescale, noting that the daily trend is up and we're sitting at the highest high high in the trend count. Once again, what we should do here is put on our interrogation hats and start thinking about what stronger sellers should have done on this morning's session and what that tells us about the state of sellers in the market all up. If you're a stronger seller and you gap down underneath a green-bodied bar, remember that the Tuesday bar closes up here, this is the close, the gap red under green is immediately putting the sellers, or giving the sellers the gift, as we call it, an advantage as we head into this morning's open. You can see based on the lower wick that we actually took out the Monday low as well. So if you're a stronger seller on this morning's gap down, what do you want to see here? You certainly want to see a lower high underneath Monday's low, if not just a gap fill reversal underneath the Tuesday low. Did either of those two things take place? The answer is absolutely not. As a matter of fact, when there was an attempted hourly inverted hammer close right here, the only acceptance that, I wouldn't even call it acceptance, but the only movement underneath that third hourly candle's low was into the top end of the tariff turmoil zone here at 546.75. It's very nuanced, but look at the lower wick of that green hourly bar. That's indicating acceptance over the top end of the daily tariff turmoil zone, which is bullish, right? And as soon as we start getting more price acceptance inside of the Tuesday range, it was off to the races into the close. So a very strong close here from the buyers. And once again, the point of going through this exercise is to illustrate that sellers had a number of opportunities today in particular to suggest a higher low underneath this. Previous inflection point, previous resistance acting as newfound support. They had an opportunity to set one underneath Monday's low, an opportunity for a gap fill reversal. Sellers did not step up at any of those potential lower high spots to change the hourly trend to down, which would have not really broken the daily base case at all. We know that the daily could have pulled back for a higher low. It simply didn't happen. There was no hourly trend reversal here. You could even make the argument that if we rejected Friday's highs of last week on these back-to-back inverted hammers, then perhaps there was maybe the argument for some sort of head and shoulders. The hourly trend would reverse back down underneath 544, and then we accomplish a daily higher low pullback to here. It's just not even a talking point with the forecast for a gap up here in the after hours and the close back at the equal high for today's session in particular. So the buyers are in control, and the game plan for tomorrow's session into the end of the week is going to be fairly straightforward here with our gap rules being in play. If we open on a gap up near the 50 SMA, it's very reasonable that you might get some sort of rally rejection of 561, a little bit of a hang up at the 50 SMA, and a pullback to close the gap. I would give some leeway, some breathing room into this level here at 554.85. Just like the sellers would have wanted to see a lower high underneath this level from back here, Monday of this week, the buyers this time around on a gap up, if it fades, want to suggest some sort of higher low over the top end of the Tuesday high and today's closing print at 554.85. If that can be the case, I would be looking for long opportunities off of that pullback for the gap fill reversal back towards the high of day and this daily resistance coming at 561. If we can balloon runners beyond that, your next target is the upper edge of the weekly expected move and 566.25 coming from previous structure. If the market does open on the gap up and goes for a gap and go, I would look for higher lows over an upward sloping VWAP. We'll change to the blue crayon for that. There we go. Upward sloping VWAP here, as well as a higher low over the key level at 561, potentially trades into the upper edge of the weekly expected move in 566.25, the same level that we were just talking about. Anything that goes beyond that, I would start thinking about 569.75, and this is actually a major spot on the daily time frame chart where I would be expecting sellers to be waiting there, ready to offer some sort of pullback. Even if it's not a trend-changing pullback, some kind of reaction off of 569.75 seems reasonable based on the daily and all of the interaction points we've had from back over here. Remember that we had look above and fail. This lower high, ultimately the tariff news paired with that, was sort of the origin, the scene of the crime, if you will, to this last leg lower in the market. So 569.75 is one of those spots where buyers who are trapped from that location may look to get out for break even, which is once again why I'm expecting some sort of potential response off of that level as something a bit more substantial. Let's go back down to the hourly time frame here. What if the market is going to reverse? What if I'm wrong about the bullish thesis and more so a bearish pullback is going to develop in a more severe way? Then you'd probably have to deal with a gap up open that fades not just into the previous day's range, but for me it would have to be underneath the 551. Why would that be the case? Simply noting what happened with the last, not the last two, but the second to last two, if that makes sense, hourly inverted hammers that started to show signs of rejection near that level, but there was no follow through into the close. So this is not enough of a pullback for me to get bearish and say, oh my goodness, the hourly trend is going to change. You would have to fade the gap and some to get in here. Then I might change my tone on a Brigade bolt back down underneath the top end of the tariff turmoil zone here at 546.75. Now, the key question to always bring this back to is, what did we talk about on the monthly? What did we talk about on the weekly? What did we talk about on the daily? Right? We're sort of bullish across most of the higher time frames here. And when and if the hourly trend pulls back like this and reverses in the downward direction, I would still keep a very open mind to a daily higher low around this gap fill reversal. That narrative, that thesis has not really changed here. If anything, we're just pulling back from a higher high in the trend count. And this was a soft higher low. It was not a firm higher low. So I would not consider that a violation of the daily trend count, right? So that's my take here on the S&P. We can throw on some confluence with our good friend, the intraday anchored VWAPs. Notice, again, it's not like I don't pull these numbers out of thin air. There is some confluence here at the 546.75, which is why that's such a key level that needs to break down, and a lower high has to be found underneath if the sellers are really going to make a stand here for a substantial pullback. Other than that, it's just consolidation near the highs. This is like totally bullish consolidation, and I would expect continuation over the course of time into that daily target we just mentioned at 569.75. If we bring out the Fibonacci's, recall that we used these on the Saturday update video. We've got a little bit of an extension to the upside here. It doesn't really change the fact that a pullback towards this gap zone is about a 50% retracement, but it's still over the 61.8, which is a classic line in the sand from a Fibonacci analysis perspective. So bullish until proven otherwise. I would suspect that gap fill reversal or pullbacks over 554.85, my apologies, here is going to be the top watch for me to then rotate back to the upside. If there's no signs of buyers stepping up there, I'll still give the market the benefit of the doubt, but perhaps coming into range, I would be more interested in the long on a Brigade bolt back out of range. That's once again over the 554.85. We'll make sure to get the number right that time. Let's jump on over to the market internals for the S&P in particular. If you're not familiar with this dashboard, check out the video tutorial in the top right-hand corner. A little annotation should be popping up on the YouTube screen. If it's not there, you can check in the description. But regardless, what we want to talk about today is the fact that the internals technically read bearish, but what I would really focus on is this, right? It's the idea that the market gapped red under green. We talked about that on the daily, right? And the hourly combo there. The previous day's settlement was way up here. So all of the volume is going to register as down volume until we get to the very end of the session here, and it starts to flip back in the upward direction once we recapture the previous day's settlement. But if we take a look at what was actually happening intraday, right? You did have a strong intraday uptrend after that morning thrust to the downside. Your advanced decline line got quite close to the zero mark. And notice that after the thrust to the downside, the index score, which measures from the opening print, not the previous day's close. That's a very important distinguishing factor here. From the opening print, this actually neutralized and got very close to the bull side here about midday as we moved through the opening print, right? So that was your sign to say, okay, let's lay off the bearish thesis here and let's start changing our tone back in the upward direction with the understanding that this is somewhat of a skewed read on the intraday. If you take a look at the ticks, and of course this doesn't matter, it's tick by tick, it's not relative to the close or the open, you can see there's a small bearish build here. So maybe at the exchange level, a little bit of hesitation on the gap down this morning, but certainly nothing that is an overwhelming bearish build that would have me overly concerned about, wow, I can't believe the market rallied on a bearish build and we've got to pull back and crash tomorrow. Not really the case. I would say if anything, this is neutral, as the market technically put in. If we just go back to the daily time frame chart, I didn't really acknowledge it, but it is technically a bullish outside bar where we opened on a gap down and closed over the previous day's settlement as well. It's a bullish outside bar. It's an engulfing bar, if you will. So that's your market internals. And again, I think it's supportive of the idea. It's twofold. Number one, sellers did not make it happen here off of the open. And you can see that based on I can also show you this, the breadth ratio into the close, right? If I just expand this a little bit, really bearish breadths here, not nearly as bearish into the settlement, right? Big improvement throughout the day's session. So in the morning, there's reason to be cautious, absolutely, as the market was doing this. But as we start getting acceptance inside of the previous day's range and this starts to get a little bit more mild as the index score was flattening out towards zero, definitely much more of a open mind to some long trades at that point. So that's your internals layout. And once again, it does not support the idea that we have stronger sellers entering the market. If anything, we have a neutral stance right now, if not bullish price action speaking for itself, with the market clearly closing much higher on the session. session. Let's take a look at the market in not internals, but rather the profile for the ES futures here. If you're not familiar with this type of chart, check out the video tutorial in the top right-hand corner. Same thing as the market internals. It should be an annotation on the YouTube player. If you're looking at the value over the last couple of sessions, here's Monday, here's Tuesday. You can see on today's session, value is technically overlapping to down. Point of control did not migrate higher with price, which is going to make our job, easier. We've been talking about in live streams recently about the spectrum, right? Nothing's easy in trading. Execution is especially difficult, but there are some things that are easier versus more difficult in terms of a spectrum. We've been also talking quite a bit about thinking about markets in terms of a gradient, right? This is not a black and white binary up-down. It's much more of a gradient of opportunities that the market suggests, I should say. Anyways, getting back to the market profile analysis bit here, you can see that we have a spike. And the spike from M period is going to be fairly telling because what it will do is tell us how bullish we should remain or if we should promptly change our tone looking for another attempt at a pullback, right? So the spike only happens because the market closes at 4 p.m. The auction is not given a chance basically to suggest whether or not these prices are fair. And so what we'll be watching for tomorrow morning is if we do open on a gap up, do we gap fill reversal and stay over the spike in the first place? That's a very bullish indication. Do we look into the M period single print and come back out? That would be another pretty darn bullish indication. If we close the spike, meaning move to the M period spike base in here, and then rally back out of range, that would also be bullish. And I would probably say there's a long setup on a move over today's high. The part where we start to walk back the bullish nature of the move, though, is if the base of the spike cannot hold. If this can't hold here, I'll even just extend this off to the left. Notice that you're not really holding over the value from the Monday session. The Tuesday value starts to get underwater, and you could certainly see that it wouldn't be unreasonable that the market rotates back down towards the point of control from today's session, which is much more just balanced inside of the range, as opposed to getting continuation of this trend in the upward direction. Another nuance that I'd like to pull out from the market profile in particular is the single prints from way back over here. Look at the low of day on today's session. A period is right there. Here are your single prints from B period back on the 24th. Which of course was Thursday of last week when the market rallied in the upward direction. You could see that we tested the top of the singles, but the market didn't go a tick lower. So what that would indicate to me is that short-term momentum buyers are in control of this market. This is a very nuanced data point that only short-term traders are probably aware of, right? So short-term momentum buyers in control here. The 6 o'clock futures open actually just opened up here, and it looks like the market is trying to accept a little bit of this gap in the upward direction over the previous day's high. Obviously, it's been 50 seconds since, you can see right here, here's the clock. It's been 50 seconds. Let's not jump the gun. It's a long way to go until the 9:30 open. Anyhow, that's the market profile analysis. Again, this here is a bullish indication, the failure of the sellers on the gap down with some degree of morning momentum to rotate through the single prints out of the P period post, not P period, but rather the P-shaped profile post from this Thursday session of last week, right? So that's what I've got for you over here. Let's jump back on over to the platform. Let's take a look at the NASDAQ side of the market, which is going to be influenced even more so by, of course, our big tech earnings here. Let's go up to a monthly time frame chart to begin with. We know the analysis is very similar in terms of the location of the bar right off of this previous high, acting as support now, closing inside of the previous month's range. The same analysis stands here. The monthly higher time frame chart for the NASDAQ is bullish on that front. If we look at the weekly time frame chart, you'll notice that the lower wick of the weekly bar that's developing, it's not closed, is acting as support already off of what would have been the threat here. There was a stronger close as of last Friday anyhow, up and over the level. So a little bit more optimistic and bullish on the QQQ anyhow. Let's take it on down to the hourly time scale and the daily here. Starting with the daily, of course. And let's actually reset this to the QQQ. There we go. And let's take a look at what we can see from the trend count. So it's a rinse and repeat analysis basically of the S&P where we have a major low, the capitulation low, this set of higher lows happening here. And of course, the pullback that happened on today's session looked into the tariff turmoil zone, which is this box right here. You can see the lower wick from today's session. And just like the S&P 500, it is a bullish engulfing bar. It's a bullish outside bar where we opened under the previous day's low, closed over the previous day's settlement, We are getting a little bit of hesitation here at the daily 50 SMA. It's not an end of the world style resistance where I would say, oh my goodness, it's going to crash the market. I would much prefer to see, if the market's going to see some substantial downside, price acceptance underneath the horizontal level here at 465.85. If the market were to reverse and suggest a lower high underneath, again, gap close, I would still be thinking about the DHL shipment because the trend is ultimately up. Just in case you missed it on the first go around, there's the low, here's the higher low. This could still offer a higher low, and at this point, we're clearly pulling back from the highest high in the daily trend count. So there's nothing about this that would give me hesitation at the daily higher low. Of course, once again, if we play it out, we will have to be open-minded to the threat for a lower high here, in which case we have look above and fail on the balance range. This is your look above, this is the fail if that's produced, but the base case would outline, let's take it one step at a time and look for the daily higher low first. The more optimistic take here is, once again, look at the after hours. The forecast for now is around 481. Let's hover our cursor at 481. That's up around in here. I would certainly be thinking that any gap fill reversal is positive back up into this target. That's going to be at 485. If we go through that, the upper edge of the weekly expected move is kind of in no man's land, and the next major structural target is at 493. If the market pulls back and supports here, if there's an hourly downtrend accomplished to get there, then we'll call this the next higher low in the trend count. But as we can see here on the hourly chart, there actually was not an hourly downtrend that developed. You opened here, you tested below, but there was no lower high that was formed. And as you can see, there's a clear equal high close. So the hourly trend, if anything, like if you really want to stretch it, you could say it's neutral in this box here instead of remaining in the upward direction, but the gap up will instantly provide that higher high we were just talking about. In terms of nuance with the Fibonacci's coming in from the low up to the high, the 61.8 is the line in the sand at the gap fill reversal. That's our daily higher low line in the sand. That's 447, was it 35, 25? 447.25 as that line in the sand must hold if the market does pull back more aggressively. But is that even remotely the base case? No. Again, the base case is just like the S&P. An open up here probably signals if we rally and pull back, I'd be open-minded to gap fill reversal, or we'll give it that leeway just like we did in the S&P. The number here would be 473. 473 out of the QQQ. So an open on a gap up, rally, reject 485, pull back, gap fill reversal is the first place I'm looking for buyers, something that looks like this back to the equal high. If we go through it, something off of 473, back here to 480, back up to 485. And of course, the opening print will play a key role. We'll see where that open ultimately is in relationship to the 480 level. I'd be neutral if we fell underneath 473 to give you an idea, right? If we open here, we do not suggest a gap hold and we get something that looks like this. Yeah, on this range, absolutely. Failure to move higher, failure to hold a higher low out of the range over 473, I'd be neutral through there, but I would reserve the bearish sentiment for a firm break and lower high underneath 465.85 before I'm really scouting deeper pullbacks to get into this gap close down below. Doesn't mean, once again, I want to be very clear here, just because bullish is the nature of the higher time frame charts, even the hourly chart here on the gap up tomorrow, or at least the forecast of that, it doesn't mean, like, you could look for sellers to step up here and try risk reward along these lines. The thing is you're just going counter trend. So you'd have to understand that you don't want to overstay your welcome on the short side, and it probably requires some sort of failure pattern up here around 485. Right? You'd have to test above the level, lower high intraday underneath, maybe break the opening print, then the gap close becomes your trade to the downside with risk reward along these lines here, right? So that's really how I'm navigating this. But generally speaking, if you're someone who's here for a longer time frame perspective on the market, the gap up here and everything that's going on with earnings, the daily trend count remaining in the upward direction, there's really no threat to the uptrend or the reversal that we've seen thus far based on the information we have in hand right now. Now, of course, Apple, Amazon earnings Thursday after the close. We have the full labor report Friday morning. We'll see how that stuff rolls in. But as of right now, the buyers are in control for all the same reasons we talked about in the S&P. Let's quickly check in on our anchored VWAPs just to be sure. Beautiful confluence, 465.85, no issues with that. We already looked at the fibs. Let's take a look at our good friends, the NASDAQ internals. What do we see over here? Again, not a shocker that your breadth was technically negative on the session. Advanced decline line getting here. That's because of the disjoint with the gap down underneath the previous day's settlement being so severe. However, we saw it on the index score out of the S&P. really not overly concerned about the intraday action. The fact that it neutralized as we moved over the open instead of remaining firmly negative, that's the biggest tell, and we'll walk away with that as our major sort of takeaway from the internals dashboard. So all set here out of the NASDAQ. Let's get on over to the market profile for the NQ. And I think what we'll see is just very similar, where if we just extrapolate today's low, doing something like this, there was no rotation into the single prints from back over here. The value area was overlapping to down on the previous, here's Monday, here's Tuesday. Here, of course, is today's Wednesday session. So overlapping to down, point of control was slightly lower, but we do have the spike. So spike rules will be in play along with the gap rules to help us navigate this high. So we're going to open on some sort of anticipated gap up. If we fade and stay over the spike, perfect gap fill reversal. That's the most bullish outcome. If we dip a toe into range but promptly come out without closing much of these singles, great. It's another really bullish outcome. If we close to the base of the spike, the buy signal is moving back out of the previous day's range after setting some sort of higher low here. Any non-hold of 19.6 starts to become a little bit more concerning, where I would be open-minded to the neutral stance we just talked about on the QQQ cash. And then if we did break and Brigade bolt underneath that 465, what was the number? 465.85 level right here, that is where we start to become a little bit more open-minded to actually trading for those pullbacks, seeking an hourly trend reversal, right? That is what we have on the QQQ. Let's finish up the three indices with our good friend, the IWM Russell 2000 and the small caps. On the monthly time frame chart, what do we see over here? Strong monthly bar, not quite as strong as what we have out of the other three. If we do something that looks like this, notice that we've still closed underneath the threat of these prior highs, which were acting as support here. So there's still the threat of a monthly lower high. Yes, the lower wick is impressive. It's not nearly as impressive in terms of the location. It's a bearish breakdown, as a matter of fact. It's not really a monthly high or low. So there's some concerns. There's some issues. We still have the monthly 50 SMA acting as resistance also. And notice, not to be a hair splitter here, but if you take a look at where we've closed on the IWM monthly, it's technically underneath the previous month's range. So you do not have all of the same bullish indications going on small caps as you did in the S&P and the NASDAQ. If we quickly flip down to the weekly, you can see that it's a little bit more of a tepid bar here. We don't have as much of a strong candle body that's developing. Again, it's still early, but even if we take it one step further, for all the same reasons, right, it's the same thing. You can see that the small caps are still on a relative basis much weaker than what we have in the S&P and the NASDAQ. And for the most part, if you're thinking about this more fundamentally, right, the Magnificent Seven and the hyperscalers basically are going to come out here as of the close today. Meta has announced that they're going to increase CapEx and spending on that AI infrastructure. You're not going to get the same thing coming out of smaller service businesses spread across the IWM, right? That's just not how the small caps work there, where they have deep pockets and can just reach in at any point, regardless of the more fundamental backdrop. So not shocked to see the underperformance from the IWM for that reason. If we go down to a daily time scale, let's take a look at the daily chart here and the trend. So it's not to discount the fact that the daily trend is certainly trying to flip in the upward direction too, right? We have lows, we have higher lows happening here. There was finally an hourly downtrend through this. There's no hourly downtrend here as these bars are back to back. So this is maybe a soft higher low. And notice the location of that soft higher low. It's over the close from the 90-day pause high as well as the top of the gap from Wednesday of last week. So any further consolidation in here, I would have to dub it bullish consolidation until proven otherwise, with the failure of the sellers to, number one, right, on the look above and fail, make it to the bottom end of the range and break the bottom end of the range. You can even take a look on the hourly time frame chart here. If we do something like this, this is look above, this is fail. You moved close to the bottom end of the range, but there's certainly no attempt to break down into the gap, to close the gap. The daily trend is still up. We know this is a soft higher low, and of course, we've closed right back up at the range highs. So the outlook out of small caps is going to be very straightforward. You just want to sort of look for acceptance out of the range again at 195.15. If that can take place, that would be a little bit more optimistic as a tailwind for the S&P 500, but I wouldn't wait up and say like, oh, the small caps are so divergent to the S&P, I can't possibly take a long in the S&P. Don't forget that, yeah, the IWM maybe has a little bit more influence over the S&P compared to the IWM's influence over the QQQ, but just invert that for a second and say, what's the QQQ's influence over the S&P? And what is that relative to the IWM's influence over the S&P? Obviously, the QQQ is going to win that battle. So I wouldn't wait and just twiddle my thumbs here saying, oh, I'm waiting for small caps to get in gear. If NASDAQ is performing just fine, I would certainly be more open-minded to that S&P performance. So that's sort of the take here. The levels are clean. I don't really think that there's much to write home about other than balance rules remaining in force. We'll be neutral through here. We'll be bullish above with the idea that the weekly threat, the monthly threat still persists at 198.200. If we can clear it, that's where I would say it's full steam ahead. S&P should be very confident on the long side if we can clear that monthly threat, that weekly threat that we were just looking at. If the market's going to break down and close the gap, I would want to see something that looks like this, higher low back in range. That is where, right there, where I'm pointing, this dot over 190, we would be back to confident on the long side. If we're just underneath and here, I would keep an open mind that of course is a failure of the 90-day pause high, which is kind of detrimental, and this starts to feel a little bit more like look above and fail from a larger perspective, meaning that the target would be here at 176. That's the disaster you want to avoid out of small caps if you're an optimist. If we want to take a quick look at the anchored VWAPs intraday, we can certainly do so. You're not over the cluster, you're not over the all-time high anchored VWAP, which is this solid one up here. It's actually just acting as resistance at the top end of the range. Getting a little bit of support underneath us off of this anchored VWAP from the Monday fake out of last week. Maybe we'll watch out for that, but for the most part, I would say that the range rules are going to dictate what we should be thinking about here. Just to be congruent, we could take a look at the Fibonacci's low to high, 38.2, smack on the 190 level. Again, if you lose the full gap close and cannot support back over 190, it's a breach of the 61.8, which is mixed in with all of those lines. Let's take a look at the Russell side of the market internal, see if we can glean anything different from this side of the, not exchange, but the index. Not really. Still a weak breath here. Advanced decline line trending higher, a flat cumulative out of the tick. I would say it's the same takeaways as the other two so far. And if we just take a quick glance over at our good friend, the market profile, all this does is sort of confirm the look above and fail, right? Where value is much more overlapping to down and the point of control is in the range rather than the breakout sticking, up and over something like the 1970s mark. If we just zoom out on this chart, also doing something that looks like this, if you really want to, get into it, you would say that the point of control should be over 1980, this previous high from back here, if you were going to accept above. Obviously, today's range was just entirely inside of that prior bar from back here. So not much bullish action to write home about on that front. If we do take a look at the low, it goes a little bit deeper into the single prints of this session from last Thursday, right? And that is noteworthy there. Let's go ahead and jump back on over to the platform. Let's round out the sectors for our S&P 500. Let's get a more holistic view of what's actually going on here. So what's the weekly performance look like as this rally extends in the upward direction? Leading the pack is real estate, then we have healthcare, then industrials, materials, staples. Automatically, you should be thinking, okay, a little bit of a white flag here. White flag just meaning we're getting rotation out of the less important defensive and lighter weight sectors. They shouldn't really be the ones that are fueling the rally in the upward direction here. So I think what's really important, and this is kind of hinging on obviously earnings in the after hours, is whether or not the tech companies can follow through into the end of the week. And of course, we'll cover that in the Saturday update video. What's underperforming here is energy and discretionary, and then semiconductors are the laggard. I would expect that to change into the end of the week as, again, we're getting this gap up. And perhaps, right, perhaps we get a one-day gap up and then Amazon comes out and says, no, we're actually doing the opposite and unwinding all of our spend on AI infrastructure. I wouldn't forecast that to be the case. It's a very competitive landscape right now. But if that happens, we'll, of course, have that conversation on Saturday when we can revisit the total weekly performance on the sectors. But for now, small white flag. It's really up to tomorrow's intraday performance to correct this and see if the weekly performers are going to shift to the heavier weight risk-on sectors. If we look at the structure here, is it overwhelmingly concerning? Is real estate blasting to new all-time highs? The answer is no. So real estate is sort of rotated higher. It's over this. And I think just from a rotation perspective, if we go over to something like the XLK, we could find it. There it is. Notice that, excuse me, tech was already over this as of the close of last Friday. If we just go back to real estate, right, we sort of closed underneath and weak in here. So you're getting a little bit of that catch-up trade in some of the weaker sectors. That's kind of one of the things that I'm thinking about. Same thing with healthcare, right? It's not even close. Like on a relative basis, the XLK is trading up here. And you can see that healthcare is just now breaking out of this. This is actually a topic of conversation that we had last Saturday, saying that if the market's going to remain healthy, we do want to see some degree of rotation. And I think this is actually supportive of that thesis. So again, as we lean into the monthly bullish thesis and that huge hammer candle, key structural levels, weekly chart looks okay as of right now, trying to dodge the threat of the lower high. Daily trend is up. There's no threat to that. Gap up through the after hours. I think this is all tying into it's still the right side of the market to be on is the long side as we're pushing higher here away from the capitulation low. Industrials, nice hold over the top end of this level now. Love to see that. There is no lower high rejection underneath. Previous support did not act as resistance. That is a bullish flip there. If we take a look at materials, it's a lighter weight sector pushing in the upward direction. Again, no strong resistance on the first go around. Notice the inverted hammer was the only resistance we had there. Inside bars finally breaking out on today's session definitely supports more of that bullish narrative as well here. XLP consumer staples right back up into its breakout point. If it does break out, once again, think about the rotation thesis. If we look at XLF financials, doing quite well. Also holding up over the neckline of what could be considered the double bottom here and not really getting any threats of the breakdown back underneath the, not double top, but rather the head and shoulders neckline from way back here. It's almost confluent, same number, 4760, but for now, buyers still remain in control. We like that the 200 SMA is now acting as support, the lower wicks of these bars. TLT, bonds, kind of in the neutral midpoint of this overall range. Once again, I think that sometimes you don't have to have a trade idea on every single chart. It's sort of still how I feel about the TLT. It doesn't seem obvious to me what's going to happen here, especially just with the landscape of interest rates, which we'll talk about in just a second. XLK over the level, and of course, threatening a further gap up through the after hours here. 213, 214 is the bid-ask spread. So somewhere up here on the forecast open, giving room for a pullback. Once again, even if you test this, even if you go gap fill reversal, 50 SMA is now acting as support. Something along these lines remains bullish for the thesis to reverse the market in the upward direction. Utilities still neutral inside of its balance range. Not much to talk about there. Communications, let's see, after hours, not getting as much love there. And, that's fine. Of course, communications is not going to have your Meta or your Microsoft. There we go. The XLK not gapping it up as much there. So not really overly concerned with the move as long as it can try to at least prevent a stronger pullback off of 95. We'll keep an open mind to it. But for now, the chart's like not sounding alarm bells. I would frame it that way. If today was going to be a more disastrous day, you would have closed back down underneath the daily 200, underneath this cluster of lows here, offering a deeper move to retest this 91 perhaps. It just didn't happen with the strong close near the highs. We'll see if tomorrow's euphoric tech open can fuel some of this stuff in the upward direction over 95 for a stronger daily close there. That's the next watch out of that. Semiconductors, the reason I mentioned in the intro, and perhaps it threw some people off, I know we're talking about Meta earnings and announcing the CapEx spend, but remember where that money gets funneled to. That's why I specifically called out NVIDIA, also up 3.5% in the after hours. You can see that SMH is, it's not maybe the same percentage amount. Let's take a quick measuring stick out and do it. If we come from here, what is it? Let's say 214 to split the bid-ask spread. 214 is about in here. So you're only up about 1.25% out of semiconductors as an ETF, the SMH. But regardless, again, the money is going to get funneled from the metaverse into NVIDIA, which is then going to get distributed to TSMC to produce the chips, right? So this whole cycle is just continuing to reinvest money into the names that are moving the market right now. So on SMH with the gap up tomorrow, we're gapping up and over the rock and a hard place level. If you recall from the Saturday update video, this was our rock and a hard place, the tariff turmoil zone basically. Over 211, the buyers are much more in control. Right, the lack of a lower high here up against this previous low is pretty telling out of semiconductors, so we'll be watching for that. XLE, no love out of this. Going to continue to watch for a possible higher low. Remember, you don't want energy to fall off of a cliff. Yeah, cheaper energy prices are great, but you also want to avoid the recession risk where it's like, okay, global demand is really slowing down, and remember, we'll always reference the CL chart for that. And as we take a look here, it's certainly not looking good, and the GDP print this morning was no help for that particular narrative. So we'll watch out for that. I think that the recession narrative is still something that's worth talking about, even if the Mag 7 companies are going to continue to invest in their AI infrastructure. And remember, right, this is a very important point as we're specifically talking about crude and this recession narrative in the face of an SMH gapping up and over a key level. The economy does not equal the market, right? The economy does not equal Mr. Market over here. So please understand that even if a recession does happen, and the signs of a recession are there, if the S&P is in an uptrend across multiple time frames with the support of the Mag 7 on decent earnings and forward-looking statements, it's probably not worth being the bear and hating the rally the entire way up and trying to short every little high that you think is going to cause the big reversal. Anyways, that's my 2 cents there. Let's move along to the XLY and let's see what's happening here. You can see the nice hold over the 192.75. I like it. That lower wick in here is suggestive of lows, higher lows, coming from the highest high, ultimately looking for follow through in the upward direction. Not much of a sympathy gap starting to unfold here yet. We'll see if we can't get up and over this local high to end out the week. That would be the next bullish advance out of discretionary. Let's look into our sector ratios and see what's happening from this point of view. As we take a look, if you're not familiar with this dashboard, by the way, check out the video tutorial in the top right-hand corner. The green shoots persist. Look at this. The double bottom is breaking over the neckline and getting some acceptance over the 50 SMA. If NVIDIA can follow through, if Microsoft can follow through tomorrow, I would expect these names to continue, or at least the sector performance to continue in the upward direction. We'll watch out for that. It would be great if this could sustain a higher low and then break out more firmly over these equal highs. So a little bit of a neutral stance here. This is still looking great out of financials for a higher low over the 50 SMA, still upward sloping. This is defensive, so we'll go neutral. I like the fact that this is pulled back. It's still over a 50 SMA upward sloping, so it'll be neutral there, but it's no longer as much of a threat for an equal high breakout, suggesting that risk off is still the narrative. Same thing to be said about utilities down here in the lower left. As we look at something like our specialized ratios in the first A-B set, you can see that we still have the same exact indication. Green shoots are firing. This is bullish happening here, double bottom. Next step is to break the neckline, of course. I like the fact that we're testing the 50 SMA from the lower low. It would be great if this could get follow through over the 50 SMA. This one is coming from the lowest low, so once again, this is probably where there's the most work to be done between discretionary and staples. If this were to pull back and go inverted head and shoulders, fine, that's a different story, but once again, you would need the break of the neckline higher. I do like the higher low hold here, possibility for a higher low. Attempted breakout, it's not really sticking yet, but still, once again, for tomorrow's session, that is subject to change, noting that we have the semiconductors here. ARK-K, the innovation fund, equal high. I like it. I see green shoots here more so than anything else. I see the opportunity for trend reversal in the upward direction for these leaders to come back as leaders and truly reverse this market that we've seen over the last 2.5 months or so. Gold is no longer outperforming on a relative basis, so the risk off flight to safety trade, I'm not going to call it completely over, but it's definitely not in the throes of it right now where money is just piling into gold and not equities. If we look at Bitcoin as a risk on-off signal, we do have the Sailor Shift tool firing a green bullish signal here with the close over 92,000 as of last week's bar. This is a weekly candle here, right? So that is a helpful risk on indication, risk appetite increasing. And then you'll notice that the TLT, it's very nuanced, but it's what we were looking for in last weekend's update, is a lower low, right? If I hover my cursor, you can see it. We actually closed on a lower low for today's session. Ideally, this would just start trending in the downward direction more cleanly. Highs, lower highs, lower highs, and some sort of more meaningful lower low would certainly feel better. Like, don't get me wrong, I don't want to split hairs here and try to be confident on literally a hair's width of nuance. It's not my preference. I would prefer a much cleaner lower low, but we'll watch that and we'll take it in stride in terms of being an indication for a stronger risk appetite to return to equities all up. Let's take a look here at the dollar and interest rates, kind of stable out of the dollar, which is helpful. Remember that stability here is going to be meaningful. We've talked about stability and interest rates as well. Lower rates will certainly help also in terms of financing some of these hyperscaler investments, so to speak. So what I'll do here is throw up the MOVE bond index. We did this last time as well. If bond volatility peters off, which is sort of what it's doing, that gives us a more confident environment for investors to participate in, instead of one day rates are 4%, the next day they're 3.8%, the next day they're 5%. It's like, you're not going to get investors who are thrilled about allocating capital in that environment. So bond volatility cooling off is a good thing here as interest rates come down slightly for today's session. If we look at commodities just in terms of expressing these as currencies, so to speak, gold is certainly at a flush point. I'd be very open-minded to a breakdown underneath 32.85 an ounce. If we break that, right, some sort of deeper pullback to retest this high around 3,200 would be the next major watch here out of gold. You can see that silver kind of still in range. All of these other commodity metals still remained in range as a majority of this volatility was taking place. I mean, don't get me wrong, big rotations in here, but no more, no meaningful breakouts, I should say, as these moves were unfolding in markets. Let's take a look at the inverted ZT to get a sense for what the Fed tracker tool is suggesting. As this trickles lower, we know that the odds of a pause are pretty elevated right now for the May timeframe, just because the April data is not going to reflect the tariffs. And the Fed will be waiting there, but it does seem as though the market's more confident that the Fed will be bringing down rates sooner rather than later. So let's take a look at the Fed tracker tool, just see what else we can glean from it. So the odds of a pause, about 94.2% for the May meeting. Once again, not a shocker. The Fed's going to be looking for the April, May, June data, which comes out, of course, a month skewed. So you have May, June, July as the time frame where the Fed may actively make a decision. Still pricing in how many cuts for the end of the year. Does it look like we got an additional one in here? Maybe not. 1, 2, 3, 4 cuts still into the end of the year. There's a couple of different arguments there that are probably worth entertaining. Some saying that the tariff inflation is going to be very short-lived, the one-time price shock, and then after that it's going to be massively deflationary. That's the possibility where we fall into a recession and nobody's spending money on anything. So that forces prices to come down, right? That's one narrative. The other one is, no, I think that people are there's not going to be an unemployment recession. We're not going to go down that path. And maybe the price shocks cause the Fed to have to keep rates higher for another meeting here. And those odds get bumped out to the June timeframe as the Fed remains, air quotes, data dependent. We'll see if 1 month makes a trend. Jerome Powell is infamously known for, right? Let's take a look at the report from today's session. Speaking of, right, we got the GDPs, which were not all that thrilling. Let's maybe take a look at this perspective for GDP. There we go. The advanced GDP coming in at a negative 0.3. That is no bueno. So market's not really liking that, which is perhaps why the morning session moved lower aggressively out of the gates. But then beyond that, as we look to PCE, which is the inflation metric that came out today at 10, really odd that they released it 30 minutes into the session, but why is this not refreshed? Let's do it now. There we go. Looks like we came in flat, beating the expectation, and we could see that over here as well. It's the same thing here. Flat, beating the expectation of a 0.1 on the month over month. And if we look at the core year over year, the actual comes in at a 2.6, which was the consensus, and is below the prior at a 3%, which is definitely a step in the right direction for the Fed to achieve their goal, right? The Fed's mandate is at 2%. So a strong step there for the Fed. And once again, the Fed's probably looking through this data to next month's inflation metrics just to get a handle for what tariffs are doing here. As we take a look at the earnings calendar, this is really important, right? We just got Microsoft, Meta. We also got Robinhood in the after hours, and we'll talk about them in just a second also. But we want to focus on these two up next, right? We want to see if Amazon ultimately echoes the sentiment of Meta and says that, yeah, we're going to continue to remain firm in our guidance moving forward. CapEx is still going to remain strong. Apple's a little bit less meaningful there. They're probably going to cite tariffs and the influence on the iPhone, of course. So I'm a little bit less concerned about Apple. They're not really... To me, they just totally botched the AI play here. So Amazon and AWS, seeing what they're doing with their data centers, seeing what they're doing with their investments in AI, that's the next big shoe to drop, I would think, into the end of the week. As we take a look at some of these commitments here, let's just firstly note that revenue for Meta on the year over year quarter one, 16% higher, really, really strong as they try to, not try, but they're really just squeezing money out of ads still. What I do want to scroll down to is, look at this, 10% year over year on the average price per ad. There you go. But scrolling down to the forward-looking statements right here, this is what I was talking about in the intro, and it's what I've been referencing this entire time, right? The previous commitment from Zuckerberg was something around the lines of 60 to 65 billion, and you can see that they've just revised that to 64 to 72 billion dollars, which is a substantial increase, right? So once again, the market is sort of rallying on the premise that instead of pulling back amidst this uncertainty, they're actually pushing the gas pedal and saying, you know what, it's time to go all in on this AI wave. And, all the AI bubble sayers, I think that this is just a testament to perhaps them not fully understanding where AI is going to go and the influence it's going to have over economies at scale. So, I don't know, commitment from Meta. I'm not going to pretend to be an AI expert. I've certainly been impressed and wowed by some of the more recent advances in AI. And we don't have to have that conversation now, but this, generally speaking, is why the market is responding so bullishly in the after hours. If we take a look at Microsoft, you can see that they just beat straight across the board on everything as well. AI strength drives third quarter results. They, of course, do their calendar year. Hang on a second here. Let's go into 2020. Yeah, their calendar year is all messed up. Fiscal year, calendar year, they botched things. This is the correct one. April 30th, that's today's release. Throwing me off here with the Q3 thing. Anyhow, all up on earnings, and where was the highlight I wanted to get to? Where was it? Here we go. Azure and other cloud services revenue growth of 33%, right? That's really strong there. And again, driven by a lot of this investment in AI. I think scrolling down, where was it? It's somewhere in here. You can read it. Oh, here we go. Yeah, cloud and AI are essential inputs. Generally speaking, differentiated offerings in the cloud. That's what we're talking about. Microsoft Cloud and differentiated offerings. When they say differentiated offerings, they're talking about their AI offerings on Azure. So anyhow, that is what we have there. And again, a positive note for the AI trade here. As we look at Robinhood, I thought that this was pretty compelling also. Revenues up 50% year over year. Net deposits growing to a record $18 billion. Absolutely incredible out of Robinhood. And you can actually find the quote. You could probably Google it somewhere. But they note, and this is not a surprise, we've seen the inflows to the market anyhow, retail buyers, are net buyers of stocks over the last month as there were down days individually through this entire tariff turmoil drawdown that we've seen. So Robinhood looking strong here. Investors are active, and there is apparently money to put into the market. Like, if you're thinking about this from the perspective of, if we're going into recession, then people are not putting money in the market, and people are pulling money out of the market to pay for things because they're fearful that they're about to be laid off. You wouldn't see record net deposits up around 18 billion, I wouldn't think, if recession is on the horizon. So that is what we have through the more fundamental take for today's afternoon session together. Let's take a look at some specialized technical indications, and we'll keep this thing moving along. The bond market is still sniffing out some degree of fear about inflation, shorter end of the curve coming down faster than the longer end, of course, which just continues to signal that the market's trying not to get too happy about the Fed cutting rates here and in the near term versus inflation possibly coming back based on tariffs. So that's kind of what this is telling us. Still kind of an issue when it comes to that recession narrative. But again, not an unemployment recession. Like, that's what I think we'll learn most about into the end of this week. As we look at credit spreads, I find this to be somewhat not compelling on the long side. The fact that this was unable to hold the lower high underneath the previous low. Now, this is the IEF LQD. It's the more medium term versus the shorter term SHYHYG proxy. These are proxies for credit spreads. They're not actual credit spreads. But generally speaking, this, if it could stay weak and low, that would be good. I'm a little bit mindful of this one up here. And that's just because this is your corporate grade, right? Let's move into our junk bonds in isolation, still holding up just fine, not really divergent in a bearish way from equities down below. That's a non-issue as of right now. That supports the buyers. We looked at Bitcoin. Let's move into breadth instead. Apologize for the click there. Strong thrust out of the 50 SMA and 200 SMA. Stocks over or under, right? The new highs versus lows is quite literally at 4 as of right now. So that's pretty neutral there, but a big recovery off of the major lows happening over here. So all things considered, I'm not convinced that we have a breadth contraction crash that's looming on the horizon. The RSP would signal the same thing. If we were going to have that, today would have closed at the lows of today's session, threatening a breakdown of this 163. Simply not the case. You can see we've closed higher. We will be watching closely to see what the response is at 172. You can see on a relative basis, the S&P is already over that. The weighted S&P, that is already over that exact same level, right? So just being mindful, really, if you want to bring that out, it's this. If you want to bring this out, it is this right here. We're right at it. Okay, so if you want to make those things a little bit more equal on the analysis. So breadth is not a concern right now. It's probably more, well, not probably, it is more bullish based on what we've just seen and confirming the move we've seen in the upward direction. The VIX continues to trickle in the downward direction. Big upper wick on today's session, fading off the volatility from the morning drawdown. If we look at the VVIX, same idea here. It'd be more comfortable to be underneath the 103 handle. If we take a look at vol on the short time frames, like the 1 day, Monday, Tuesday honestly looked pretty good underneath the 2145. Today's session with the GDP print not going so well, perking back up. Be really curious to see if this does finally collapse on the better than expected earnings out of Meta and Microsoft. If that's the case, I think it's signed, sealed, delivered, and that's, as we said on Saturday, the final shoe to drop is really watching for this one-day vol to truly settle out and not continue to sort of suggest that investors are on edge on those 0 DTE SPX options and the hedging that takes place across those, right? If we look at the volatility skew here out of the front and back months here, still in backwardation by a small degree. If I zoom in on this really closely, and let's do something that looks like this, I just want to point out that the longer dated months here, which is the very dim gray line on your screen, is at 0. It is at 0 currently. You can see this gray right here, oops, 0. That is just an indication. If we go over here to the VIX curve, /VX, there we are. That's this. That is this. If we scroll down, way out here, this is, oops, let's get rid of that. This is the 0. That's the 0. There's no difference between these two, right? But until we get there, we are still technically in a backwardation. Remember, this curve wants to look something that looks like this, meaning that there's much more volatility in the unknown future rather than right here, right now in the present market conditions. I would be suspect that these do invert, or I shouldn't say invert, but rather revert back to contango into the end of this week, so long as earnings continue to look good, right? It's really just down to Apple and Amazon. Apple does pose the risk, I should say, to really do a little bit more damage, just noting its weight in the S&P 500. Let's finish up today's show with a couple of ideas after the core list of companies, and then we will send you on your way. Let's take a look firstly at NVIDIA. Once again, gapping up in the post-market here, up around 113. So the open is going to be just a hair underneath this area here. I'd be thinking about 50 SMA rejections, gap fill reversals to the downside. Let's go to the hourly chart to get a little bit more nuanced on this approach, actually. If we take a look here. So the gap up is loosely at the 50 SMA. I would love to say partial gap fill reversal that respects this prior high. That's the most optimal outcome, right? Why? Because not filling the gap all the way signals that the sellers are not doing their job. So I'd love to see risk reward back in the upward direction towards that 114.25. If we do get a gap and go, you would have to be respectful and sort of wait for some sort of higher low over the level so you could at least manage risk. I would think that just buying this on the gap up doesn't really give you enough risk reward into that 114.25 threat. Remember, that's the 90-day pause high. It's definitely worth, respecting that as a key level that does have the opportunity to reject market prices. Let's take a look at Microsoft and see what's happening here. Once again, earnings after hours have us where 426. Huge push to the upside. Last I looked, it was 418. 426 puts us into the previous earnings gap from back over here. So we're gapping up to this level where my white cursor arrow is pointing right now. Huge gap up, very disjointed from this. I would say that Microsoft, on the options front, you probably want to let IV simmer out of this for the first 5, 10, 15 minutes. But then beyond that, it's such a substantial gap up that you're probably, excuse me, apologies. You're probably going to see the 4 different cohorts of buyers and sellers battling for price on the open. You're going to have old money longs who are long from here, who are like, okay, that's good enough for me. I'm going to button up, take profits. That's selling pressure. You have new money longs who are like, wow, this is the best earnings since sliced bread. We're going to buy the market. That's buying pressure. You have new money shorts who are like, wow, these prices are way overvalued. Got to sell the market. This is a big short, selling pressure. Then you have old money shorts who are trapped from down here and like, oh my God, this is not what we were expecting. We thought earnings were going to dump and crash. Next thing you know, they have to buy to cover their positions. Everybody's fighting for price, and the market does what? It goes sideways, right? And it sort of makes a fool out of everybody. So the substantial size of the gap up here out of Microsoft probably makes it a little bit less attractive to trading for tomorrow's session. We'll take it step by step. It's really one of those things where until new structure builds out up here, we see what the response is to some of these prior levels. Very, very difficult to make a forecast as to what should happen next on the gap up, right? In theory, you would say, yeah, we open in the gap, we pull back, maybe support this 418 previous structure from here, and then sort of go for the full earnings gap close of this previous cycle. That would be picture perfect, but I would not be overly committed to that until we start to see some of the action intraday on tomorrow's open. Moving along to Apple. Apple is just not even on the radar because of earnings being reported Thursday after the close. I'm not interested in trading the options IV on that. So do what you will with these levels. It's not gapping up. There is no sympathy here. People are still holding their breath for Apple earnings outright. I'd say consolidation through here technically builds out a little bit of cup and handle-esque style move. Earnings gap overhead, the tariff gap overhead is something to continue watching for. But again, anything goes with earnings coming out on Thursday. The bears, of course, just want price. Really, I'd say bears have a lot of work to do here actually on Apple. Underneath 200 is where the bears come out to play. We'll watch out for that on earnings tomorrow after the bell. Let's take a look at Amazon and let's finish up the core list. We are seeing a close. And again, earnings here, so anything goes. Take this analysis with a grain of salt. I will not be trading Amazon tomorrow, or likely even on Friday, depending on IV. Maybe actually, at this point, we could go out to next week's expiration, so maybe Amazon on Friday. Anyhow, point being is that the 183.50 level is going to be your over or under just based on this box from back here. And then beyond that, the 192.25 comes from your daily level. If we just look back over here, even weekly at that point, in the 90-day pause high, 192.25. We'll see where the market lands based on that. A little bit of sympathy to the Meta CapEx spend, sort of the market's anticipating Amazon might say similar. 189 in the post-market as of right now, which brings us an open somewhere up here. I'd say for a watch, if you're really intent on trading this, maybe you're not an options trader, you're going to trade shares. I would ideally like to see that. I mean, picture perfect would be over 187.75 into 192.25, that daily threat, weekly threat we just mentioned. If we fail beyond that, this is where I would just totally neutralize and say wait for earnings to pass before making a stronger call out of Nancy. Let's take a look at Google. Google, 159, it's slightly higher, not much. small gap at this point. What's the next major step? This is a daily higher low, pulling back from the highest high. Nice hold of 157. Next outlook is finding longs over the previous day's high. Trade to here, and then sequentially thinking about it this way through the thin structure retracement into 166.35 as next steps. Let's move along to the metaverse and see what's happening with Zuckerberg. And again, the gap up is monstrous in the after hours. We have 574.50. 574.50 puts us somewhere in here. Right around in there. So a nice gap in the upward direction on this continued spend. I'd say that obviously Microsoft's gap has been a little bit more substantial as of right now. However, it gives us plenty of opportunity for two things. If the market rallies into the 90-day pause high, I would be looking for rejections there. It's possible that we can scout shorts. If you're like, shorts, what are you talking about? You could wait until you're under the opening print to start closing some of the gap down towards, roughly the next major level has to be the 554. That's where I would be next, waiting for a long on a possible higher low, especially with some of the positivity and euphoria given the announcement from Meta, right? So that's if we rally first, setting up something that starts to close some of the gap. If we just fall like a rock out of the open, be very open-minded to not the full gap close, but 554. If you want today's high, it's at 549. 549 is the exact high, if you'd like to use that. Let's move along to Tesla. Tesla's not really doing much in sympathy to anything right now. Tesla was a beauty of a trade today, working out awesome right into the full gap close. Regardless, the next phases for Tesla is that this, as a bull flag, ideally gets follow through up and over 286.85 for the daily, breakout of this as a double bottom more meaningfully. If we look at the daily chart, I do like the fact that these lower wicks are supportive over the 50 SMA. It looks like sellers are not really able to drive prices all the way to retest the top end of the range here at 260, the origin of the breakout. And if this can hold as a clustered set of higher lows, I mean, even take it from this perspective. If that's a double bottom, this is a Brigade bolt over the neckline like this, and then we just duplicate the pattern basically and say this is a double bottom. We want to break through the neckline, Brigade bolt over the neckline, and continue to look for upside out of Tesla, talking about something like 326.50. JP Morgan, let's take a look. What do we have? Just a multi-day balance here. Not much to really talk about until we get out of the range. That's over 246.50, trades into 254. That's just about a range double, so that would be a valid target. It's also the last major swing lower high that we are up against. If we do see a move to the downside, I'd still keep a very open mind, and this is not a base case, noting that the lower wick suggests sellers failed underneath these lows, but I'd still keep an open mind to gap fill reversal, sustaining a higher low over this as a bull flag here, right? This would be a higher low in the daily trend count from the highest high in the most recent high and the sequence that we have there. Moving along to Netflix before we give you 3 additional trade ideas. And if you can guess the sector before we even get there, then you're paying attention, and I like that. But what do we have out of Netflix? Continuing to grind into all-time highs. This one always throws me for a loop. The business model doesn't make sense to me. I don't know how Netflix can be trading at... I'm not even going to get into it because it's just beyond me. But if we could see holds outside of the bull flag, if you take a look in the hourly chart, it's pretty clear. There it is. Look at the lower wick today, respecting the top end of the flag. If you can hold up over that, it's just up and away. It's blue sky territories up above. There's not much to, no sense in fighting it. No sense in trying to short it. Just because I don't understand the business model does not mean that I'll be trying, it can't possibly go higher, let's short it. That's not how that works. So we'll continue to look for upside trades here as the trend remains in the upward direction. All right, couple trade ideas for you. The most hated stock of the early phases of 2025, end of 2024, AMD, the advanced money destroyer that just wiped out a ton of its value. I like the fact that AMD is opening on a very subtle gap up. You can see as of right now in the after hours, 99, 99.16, give or take. So somewhere in here. And if we see a pullback, look at how equal these highs are. In a picture-perfect world, if AMD is going to make a more serious advance in the upward direction, 97 needs to hold as the next breakout level, right? So if this is going to happen, longs off of 97, gap fill reversal, are kind of interesting to then go on to close the gap overhead and then maybe retest some of these levels at 102.50. So that's AMD. The next one, sticking with the themes of A's, let's go AVGO, Broadcom. And we could see that the levels here are, I wouldn't say identical, but generally speaking, the concept is going to be very similar, where it looks like the forecast open is 197s. 197s brings us right to these previous highs. So is it reasonable that the market might pull back from that? Yes. Gap fill reversal over today's high and the midpoint of this previous range, which is technically relevant on the hourly time scale. If you take a look at this, look at all these equal highs relative to what we're dealing with now. But if you look back over here, it was just a very simple over or under. Previous lows, resistance, 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 supported above, resistance in the upper wick. I could go on all day. If we can get support off of that, again, gap fill reversal may be worth a shot for risk reward in this direction as a day trade out of AVGO. And the last one, another semiconductor name, TSM. Let's see what's going on over here, popping higher up to 171-ish in the after hours, so just a hair above the 50 SMA in this previous level from back here. Same concept. If we pull back, gap fill reversal over 166 becomes pretty enticing for a potential long to set some kind of higher low on the hourly and rotate back up into the high. If any of these names just go gap and go, that's fine. You just want to make sure that you can exploit risk reward up against an upward sloping VWAP and not get stuck buying the highest high. Please do not get trapped buying the highest high in the overall move. That's what I've got for you in today's episode of the Midweek Market Update. If you enjoyed the video or learned anything new, let me know down below in the comments section or by giving the video a very simple thumbs up. We will be live, as we are every single morning, at 8 o'clock Eastern Time for another episode of the Pre-Market Prep. We may have coffee and donuts tomorrow for some of our labor information. We'll definitely have coffee and donuts on Friday. We hope to see you there again every morning, 8 o'clock Eastern Time. We kick it off right here live on the YouTube channel. With that said, I wish you have a green trading week, and I will see you in the next one.